from a government or a company to pay you back. That doesn't mean there's also a longer backdrop that helps explain why dips, when they happen, have tended to attract buyers over the past year. When a market has spent a long time trading higher, investors can start to treat pullbacks as opportunities rather than warnings. That can create a pattern where weakness is met with demand, which in turn can make rallies feel more persistent than people expect. The London Bullion Market Association has highlighted just how strong the prior year's pricing regime was. It reported the average LBMA gold price for the year 2025 at $3,431.54 an ounce, compared with $2,386.20 in the year before that. That's a large step up in the average level, and it matters because it can change how investors think about what's normal. If the average price has moved up that much, then a price that once looked extreme can start to look like the new range, and that can influence how quickly buyers step in when the market wobbles. Alongside that, the World Gold Council has continued to describe central bank buying as a structural theme. Central banks don't trade like hedge funds. They tend to move slowly, and they tend to think in years. When official sector demand is steady, it can underpin confidence in the market during periods of stress, even if it isn't the only driver on the day. It can also shape expectations. If investors believe central banks are likely to keep buying over time, they may be less willing to sell aggressively on short-term dips because they assume there's a long-term bid in the background. Now to silver, which has really been the headline move. The metal surged to new all-time highs, with reports citing prices just above the mid-$90 US an ounce area. One report put a record at $94.73 an ounce, and another described futures trading above $95. Even by silver's standards, that's a dramatic burst of momentum. And because silver is smaller and can be more thinly traded than gold, it can sometimes feel like it's moving in jumps rather than in steps. The scale of the move has been eye-catching, and it's not just a gold story repeated in a smaller metal. Silver has its own mechanics. It can trade like a precious metal when fear is high, but it can also trade like an industrial metal when the market is focused on manufacturing and technology demand. That dual identity can make it more volatile because different groups of buyers and sellers can show up for different reasons, and sometimes they all show up at once. The Financial Times described a retail-driven stampede and highlighted tight supply and inventory constraints, including in London. It also pointed to the fact that silver supply can be inelastic. That means it can't quickly respond to higher prices because a lot of silver is produced as a byproduct of mining other metals. If you can't rapidly increase output and demand surges at the same time, prices can jump sharply. In practical terms, you can't just decide to mine more silver next week because the price is higher today. If silver is coming out of the ground alongside other metals, the supply response depends on decisions made for those other metals too. Investopedia also pointed to investor demand and exchange-traded fund inflows. An ETF is a product that trades on a stock exchange but holds assets like bullion behind the scenes. When money flows into a physically backed silver fund, it can translate into more metal being taken out of the market and stored, which can tighten availability further. That matters because it can turn financial demand into physical demand. It's not just people trading paper contracts with each other. It means real bars are being sourced, moved, and held, and that can make the market feel tighter. PV Magazine International reported the record silver print near $94.73 an ounce, attributing the move to geopolitical uncertainty, with commentary from Metals Focus. That lines up with the broader theme of the day, policy risk and geopolitical tension pushing investors towards hard assets, with silver reacting in an outsized way. Put all of that together and you get what some investors call squeeze-like behavior. A squeeze is when buyers rush in and sellers struggle to find enough supply at current prices. That can force prices higher quickly. It can also increase intraday swings because liquidity can thin out when everyone tries to do the same thing at once. If you're a buyer and you feel you might not be able to get the metal later, you may pay up now. If you're a seller and you see the price running away, you may step back and wait, which reduces supply even more. That feedback loop can be powerful and it can last longer than people expect. It's also worth noting that silver sits at the intersection of finance and industry. It's used in electronics and in solar supply chains, amongst other applications. That doesn't mean industrial demand is the driver of today's spike. It simply means silver can attract different kinds of buyers, and that can add to volatility when sentiment shifts. In calm markets, those different buyer groups can balance each other out. In stress markets, they can pile in on the same side, and that's when you see the kind of sharp move that we've had. Now platinum, the metal rose alongside the broader complex. It didn't lead the move, but it participated in the risk premium that swept across hard assets. In sessions like this, platinum can be pulled higher by association as investors treat precious metals as a basket, even though platinum has a larger industrial component than gold. When investors buy a basket, they don't always discriminate carefully between the different fundamentals of each metal in the moment. They may simply want exposure to the theme of hard assets, and platinum can benefit from that. The LBMA's annual averages also show that platinum had a materially stronger year in 2025 than in the year before. The average LBMA platinum price was reported at $1,274.73 an ounce, compared with $955.73 in the 2024 period. That doesn't explain today's move on its own, but it does show the market has already been operating in a higher price regime. When a market has already adjusted to higher levels, it can sometimes be more sensitive to risk events because traders are already thinking in terms of bigger ranges. Now palladium, the metal was modestly higher, but it lagged the more dramatic action in gold and especially silver. That fits the pattern of the day. Palladium is often driven by specific supply and demand stories in the automotive and industrial space. In the past day's coverage, there wasn't a single dominant palladium-specific headline, so it moved more in sympathy with the wider precious metals tone. In other words, it was carried along by the tide rather than pushed by its own wave. The LBMA reported the average palladium price for 2025 at $1,150.29 an ounce, compared with $983.62 in 2024. Again, that's context rather than a catalyst, but it reinforces the idea that the whole complex has been repriced higher over the past year. When multiple metals have seen higher average pricing, it can signal that investors have been willing to pay more for scarcity, for hedging value, or for both. Let's return to the macro picture because it's central to how today's session felt. The macro backdrop is the stage, and today's headlines were the actors. You can't understand the performance without looking at both. The dollar was weaker. Barron's cited the US dollar index, the DXY, down around 0.9% to about 98.49. The DXY is a measure of the dollar against a basket of major currencies. When it falls, it often provides a tailwind for dollar price commodities, including precious metals. It can also influence psychology. A weaker dollar can make investors think about diversification, and gold is one of the most common diversification tools in global portfolios. At the same time, yields were higher, as we've discussed. That combination is unusual enough to stand out. It suggests investors weren't simply seeking the safety of US government bonds. Instead, they were reassessing risk across US assets more broadly, while still paying up for bullion as a hedge against political uncertainty. It's also a reminder that markets can separate the idea of safety from the idea of US assets. In some periods, the dollar and treasuries are the default safe haven. In other periods, investors prefer to hedge with assets that sit outside the policy system, and that's where gold can shine. There's also a real yield angle that some investors watch closely. Real yields are yields after inflation expectations. They matter for gold because the metal is often compared with inflation-adjusted returns on safe bonds. The Federal Reserve Bank of St. Louis series for a 10-year Treasury Inflation Index security, or TIPS, showed a recent print around 1.30%. Though that data can lag the live market. The point here isn't the exact level, it's that even with real yields not especially low, gold still rallied strongly. That again points to the geopolitical and policy shock as the dominant force. When investors are buying gold for insurance rather than for relative value, they can tolerate a less supportive real yield backdrop. On the data calendar, there wasn't a major US release highlighted in the last day's coverage. Trading Economics noted attention shifting to upcoming US numbers later this week, including the Personal Consumption Expenditures Price Indices, or PCE, Gross Domestic Product, or GDP, Standard & Poor's Purchasing Managers Indices, or PMIs, and the University of Michigan Sentiment Survey, which is sadly lacking an acronym. Those releases can matter a lot in normal conditions because they can change expectations for rate cuts or hikes, and they can move the dollar and yields quickly, which then feed into metals. But for this session, the market's focus has been elsewhere. When the headlines are about tariffs and geopolitical demands, the market can temporarily treat economic data as secondary, not because it's unimportant, but because it doesn't answer the immediate question of policy direction. So, what should you take away from today's action without getting drawn into guesswork? Firstly, The precious metals rally has been driven primarily by a political and trade shock, not by routine economic data stories. The Greenland and tariff dispute has raised uncertainty, and markets have responded in the classic way with safe haven demand. That kind of demand can be fast and it can be emotional because it's driven by risk management rather than by valuation. Secondly, the cross-asset mix has been striking. A weaker dollar alongside higher US yields isn't the standard backdrop for a strong gold rally, yet gold rose anyway. That tells you how dominant the uncertainty factor has been. It also tells you that investors were willing to accept the headwind of higher yields because they valued the hedge more than the income. Thirdly, silver has been the standout, and the reporting suggests it's not only about safety, it's also about market structure. Tight physical availability, retail participation and fund flows can combine to create sharp moves. When supply can't respond quickly, prices can overshoot in both directions, and day-to-day volatility can rise. That last point matters. A fast rally can be exciting, but it can also mean the market is more fragile, because sharp moves can reverse just as quickly if sentiment shifts. Fourthly, platinum and palladium have moved higher too, but more as part of a broader hard asset bid than on metal-specific news. They've been passengers in the same vehicle, even if they weren't driving it. Finally, the longer-term context remains important. The LBMA's average prices for the past year show a higher baseline across gold, silver, platinum and palladium. And the World Gold Council's work on central bank demand continues to frame gold as a strategic reserve asset in the background, even when the day's headlines are doing most of the work. That background can matter because it shapes how investors interpret shocks. If they believe the long-term trend is supported, they may react to short-term fear by buying rather than by waiting. So today was about geopolitics, policy risk and a rush into bullion, with silver's squeeze-like dynamics adding extra force to the move. The key point is that metal's strength came through even with higher yields, because uncertainty, not income, was the market's priority. If the political story cools, the market may start paying more attention again to yields, to the dollar and to the data calendar. But for this session, the headlines set the pace and the metals market followed them in a hurry. So you're up to date on what moved today, what mattered and why it mattered. That is all for this evening's Global Precious Metals Update from Wessexmint News. Thank you so much for joining me. Please follow or subscribe to the channel on whichever platform you are watching us, and the odd like and share would definitely add value. I'll be back again with more tomorrow. For now, from all of us here, goodbye.
Hey, I just found the Wessexmint and it's a game changer.
You can actually buy real gold and silver online.
It's simple, no jargon, and you can start investing for the price of a coffee.
They even teach you how it all works with their academy.
Honestly, I wish I started sooner.
Start small, learn and grow.
Check out the Wessexmint.com to start investing like I did.
Hello, welcome to this Global Precious Metals Update from Wessexmint News. Today is Tuesday, the 20th of January, 2026. I'm Robert Corran. Coming up, the close and overnight look ahead. I'll cover gold, silver, platinum and palladium. I'll look at what's happened over the past 8 to 12 hours. I'll also set those moves in a wider and longer context. And I'll close with a structured assessment of where the market stands this evening and what traders will be watching for the next session. Let's start with the spot prices, and even at our deadline, these numbers are remarkable. Spot gold is at around $4,728 an ounce, up about $126 in the last 24 hours. Spot silver is at around $95.35 an ounce, up around $5.09 in the last day. Spot platinum is at around $2,407 an ounce, up about $55 in the last 24 hours. Spot palladium is at around $1,918 an ounce, up about $61 in the last day. Those are large moves, and the story behind them is unusually political for a metals session. It also means the market's usual playbook, where you can point to one clean driver like inflation data or a central bank speech, hasn't really applied. Instead, the tone has been set by headlines, by positioning, and by a rush to reduce uncertainty. When that happens, prices can move quickly, and they can keep moving even when the normal relationships, like gold versus yields, look like they ought to be pulling in the other direction. Over the past day, the dominant driver has been a sharp escalation in US and Europe tensions tied to President Trump's demands around Greenland and fresh tariff threats. The Guardian described markets falling while gold and silver pushed to new records as investors moved into traditional safe havens. In a session like this, traders aren't trying to fine-tune a forecast for growth or inflation, they're trying to answer a simpler question. What happens if policy changes suddenly, or if trade rules shift quickly, or if diplomatic friction turns into something that hits supply chains and confidence? That's the kind of uncertainty that tends to push money towards assets that